Crypto markets are famous for being unpredictable. Prices can jump or crash within hours, sometimes even minutes. For investors, this level of risk can feel overwhelming. That's where hedging comes in. Hedging is a strategy that helps protect your portfolio from big losses when the market suddenly turns against you. In simple terms, hedging is like putting a shield around your investments. It won't stop the market from moving up or down, but it can reduce the damage when prices fall. Traders in stocks, commodities, and even airlines have been using hedging for decades. Today, crypto investors are learning to use the same tools to stay safe in a market that never sleeps. Let's break it down with an example. Suppose you own one Bitcoin, and its price is currently $60,000. You believe in the long-term value of Bitcoin, but you're worried the price might drop soon. If the price falls by $10,000, you lose $10,000. But what if you opened a second trade that benefits when Bitcoin falls? That's hedging. By taking a short position for the same amount, your short gains value as the price drops, helping you balance out the loss on your Bitcoin. There are different ways to hedge in crypto. Some investors use futures contracts. These let you agree to sell Bitcoin at a set price in the future, protecting you if the price goes down. Others use options contracts, which give you the right, but not the obligation, to sell at a certain price. And many people prefer a simpler method, moving part of their holdings into stablecoins like USDT or USDC. Stablecoins are tied to the value of the US dollar, so they don't swing wildly like Bitcoin or Ethereum. Shifting money into stablecoins during uncertain times is a basic form of hedging. The goal of hedging is not to make extra profit, it's to reduce risk. Think of it as an insurance policy. Just as you pay for car insurance to avoid losing everything in an accident, you use hedging to protect your portfolio from being wiped out by a sudden crash. You might still lose some value, but the safety net helps you stay in the game without panicking. However, hedging is not perfect. It comes with costs. Futures and options trading require fees, and if the market moves in your favor, your hedge might reduce your overall profit. Moving into stablecoins can protect you from losses, but you also miss out on gains if prices rise. That's why hedging should be used carefully and with a clear plan. Still, for many crypto investors, hedging is the difference between surviving a bear market and losing everything. Without it, investing in crypto can feel like driving on a dangerous road without brakes. With it, you have more control, more confidence, and more protection against the unexpected. The most common hedging tool in crypto is the futures contract. A futures contract is an agreement to buy or sell an asset at a set price on a specific date in the future. If you own Bitcoin and worry its price might drop, you can sell a futures contract at today's price. When the future date arrives, if Bitcoin's price has fallen, the contract still allows you to sell at the higher price you locked in. That gain helps balance the loss on your actual Bitcoin. Futures are popular because they give traders a clear way to prepare for price swings, but they also require a strong understanding of how contracts work. If you misuse them, you can end up magnifying your risk instead of reducing it. Options contracts are another key tool for hedging. With an option, you pay a premium for the right, but not the obligation, to sell your crypto at a certain price. Imagine you hold one Ethereum worth $3,000. You buy a put option that gives you the right to sell it at $2,800, even if the market price drops lower. If Ethereum crashes to $2,200, your option lets you sell at $2,800, protecting you from the worst of the loss. The downside is that options require an upfront cost, and if the market never falls, the money you paid for the option is gone. Still, many traders see it as a worthwhile trade-off for peace of mind. Not every investor wants to use complex contracts. A simpler hedging method is moving into stablecoins. Stablecoins like USTD, USCD, or DAI are designed to stay close to the value of $1 US. When the market feels unstable, you can sell part of your crypto holdings and move them into stablecoins. That way, if Bitcoin or Ethereum suddenly drops, the stablecoin portion of your portfolio doesn't lose value. It's a very direct form of protection, though it also means you could miss out on profits if the market goes up again. Some investors use diversification as a form of hedging. Instead of holding only one asset, they spread their portfolio across different coins, tokens, or even into traditional assets outside of crypto. For example, someone might hold Bitcoin, Ethereum, and a basket of stablecoins, while also keeping money in stocks or gold. The idea is that not everything will fall at the same time, so gains in one area can help balance losses in another. Diversification doesn't remove risk completely, but it helps prevent a total wipeout when one market crashes. There's also a growing use of automated hedging tools offered by exchanges. Some platforms let you set stop-loss or take-profit levels that automatically sell or buy when prices hit certain targets. Others provide structured products that act like built-in insurance against sharp moves. These tools can make hedging more accessible, especially for beginners who don't want to handle complex futures or options directly. But no matter which method you choose, one thing remains clear: hedging requires discipline. It's not about chasing quick gains. It's about protecting what you already have. In the crypto world where prices can change in seconds, that protection can make the difference between surviving a downturn and watching your entire portfolio disappear. To see why hedging matters, let's look at what actually happened in the markets. In 2021, Bitcoin hit nearly $69,000 before falling more than 50% just months later. Investors who only held long positions saw their portfolios lose half their value. But those who used futures or options as a hedge kept much of their capital safe. Their hedge positions gained while Bitcoin fell, giving them protection when others panicked. Ethereum offers another lesson. Before it switched from proof of work to proof of stake, traders expected heavy volatility. Some bought options contracts to hedge their Ethereum. When prices dipped, those hedges covered the losses, and when stability returned, they still held their main positions. This strategy helped them avoid panic selling while staying invested for the long term. These cases prove an important point. Hedging is not about predicting the future. No one can say for sure when crypto will rise or fall. Hedging accepts that uncertainty exists and prepares for it. It's playing defense in a market where most people only focus on offense. Hedging has clear benefits. It reduces sudden losses, helps you stay calm during downturns, and prevents emotional decisions. But it also comes with costs. Futures and options require fees and margin. Moving into stablecoins protects value, but can make you miss gains when the market rebounds. Diversification spreads risk, but can also reduce profits. That's why the key is balance. Hedge only the part of your portfolio that you cannot afford to lose. A common mistake is thinking hedging guarantees profits. It doesn't. It's insurance, not a money printing tool. If you want fast gains, hedging may seem slow compared to chasing the next hot coin. But if your goal is to grow wealth steadily and survive downturns, hedging is one of the smartest choices you can make. For everyday investors, the best approach is to start small. Use stop-loss orders, learn futures or options with tiny amounts, or move part of your funds into stablecoins when the market feels overheated. The goal isn't to gamble, it's to protect. That mindset is what separates serious investors from those who get wiped out. At the end of the day, you can ride the market unprotected and hope luck saves you, or you can use hedging to make sure one crash doesn't erase years of progress. In crypto, where fortunes can change overnight, the safer path is often the smarter one. If you found this video helpful, hit the like button and subscribe for more simple breakdowns of crypto strategies. Share it with a friend who invests in crypto. Staying informed is the best protection you can have.